All right, so the last week of August, the going into Labor Day weekend is following the trends. Very, very low volume moves, very light trading. Not we're maintaining a trend. We're not really trending anymore, and you'll see that in today's video when I break down the indicators. Again, the question over the last few days, and still is a question, is the small cap index breaking out? Right, that's the big question. That we need to answer whether that's the case or not. So we're going to continue to look at it today and see whether or not we actually have breakout signals. And then once we do, what's the ramifications of that? What does that mean? What should we expect when we put it in the context of what we look at each and every day on this, right? It's one thing to look at IWM, by itself and think, oh, it's really breaking out. But it's another thing to put it in context of your normal daily process of what you look at day in and day out to see, okay, within that context, does it look like it's breaking out? So we're going to break that down. And then our trade idea is a stock that had been bullish, had a very, very strong bullish move, is no longer on a very strong bullish move. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September the 1st, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get started taking a look at the S&P 500 with the market forecast indicator. There's the rally. In fact, we got to move these up higher, don't we? It's been a while since we have, so let's move them up to that high point there, and we'll move this one up to that high point as well. Again, the more we move that zero line up, the bigger that gap gets between. Remember, anything between 0 and 23% is noise. And your 30-day moving average is sitting right here at the very top of this level. But still bullish nonetheless. Strong bullish posture. Intermediate line's up above 80. It's way up above 80. In fact, what's this line? This is just kind of where it was at before. We can remove that. But we are well above 80. The market sentiment line's well above 80. The near-term line is kind of bearish diverging. You got this bearish divergence, lower highs. In fact, it's been gradually lower highs from the cluster, and we've been getting higher highs on each one. So we've got some divergences going on there. Like the last, this little divergence here didn't go down to that low point, and now this divergence is even less than that. I mean, this divergence puts you at about 44.66. So it's not even that much of a decline just to get to that target, much less that target. Of the prior divergence there. The momentum line is oversold again for a second consecutive day. That sets you up for a bullish intermediate confirmation signal. So you've kind of got two short-term signals that are opposing each other. A bearish signal here with the near-term line, the blue line, and a bullish signal with the momentum line and the intermediate line. That oversold condition in the short term with an strong posture in the intermediate term is a short-term buying signal. The issue is whether or not we are starting or going to continue this near-term run that we're on. You can see when the near-term lines makes its way. Now here we did dip below 50, but never did get in the bullish zone. So we're really kind of on one big long intermediate rally. We were on it's kind of similar to this one here with the intermediate line just dipped below 50. So now the question is whether or not we can actually bounce off of this and maintain the current near-term rally, or is the near-term line done? Which one of those short-term signals is going to play out? Of course, with the posture as strongly bullish it is, you would lean towards the bullish signal playing out, and with the near-term line forming its pattern there, that would suggest that you wouldn't expect it to go up very much, right? I mean, we're getting very small ranges, half of the average. The average itself is extremely low, so we're getting ranges half of an extremely low average. So very, very light, very, very light volume as well. So I wouldn't expect too much of a bullish move coming out of that. If you take a look at the Russell 2000, you'll notice that we do have a strong bullish posture here, but we also have an even more stark near-term divergence with a dip out below 60 and obviously lower highs with much higher highs on the index itself. So it's a little bit more drastic there. We did have a bullish intermediate confirmation signal yesterday and then that played out with a little bit of a bounce here today. But again, it's very similar to what we saw in the S&P, like how much, when you don't have the near-term line, ideally you want to get the momentum line in oversold territory and the near-term line down in bearish territory, so that you can bounce off of these with a good new near-term rally. That wouldn't be the case here. We'd be extending a near-term rally that we've already been on rather than starting a new one. So you wouldn't expect as big of a move coming off of that. We're still only 3% higher. I was showing this in class today. If you look at where we were the last time the intermediate line got up to 89 when we started a bullish run. So this is the last time we really started a good bullish intermediate rally. On this day, the near-term line got to 86 and then 92. So we got the 86 right there, and then 92 on the next day, 93, 92. And you notice we were about 6.5% to 7% above the moving average there. We're only 3% now. And then over here, after that little bit of a pause, remember the S&P 500 actually did get a new intermediate pullback there, or continuation of the intermediate. So this is the post-election intermediate run that started. And you can see the intermediate line got to 80, it got to 90 on this day. And if you look, we were 8%, 7.92% above the moving average. So this is a relatively weak move above the moving average for an intermediate posture that is as high as it is. I mean, again, if I were to edit this line here and put it at 7.92, off of that peak right there when we were just starting this new bullish intermediate rally, they eventually got a cluster and really solidified it. But we were well off the moving average at that point. Very, very strong, solid run higher. You notice we haven't had since, and we haven't had now. In fact, even if you look at over here when we were breaking up above to 85 and to 88 there on June the 8th, where it looked like maybe we might be breaking out above 80, we might be starting a new move. You notice we only got 4% above the moving average. We're even less than that at less than 3. So, it's really, not a very strong bullish move higher here on the Russell 2000. Of course, the NASDAQ coming off of a cluster a couple days ago, also giving us that bearish divergence with slightly lower highs and the higher highs on the index itself, and close to a new intermediate confirmation signal there as well. Again, only about 3% above the moving average itself. Let's take a look at some of these other indicators. The long-term crossover chart still very bullish, and you still got, again, if you look at the Hakinyashi candles, we're still kind of grinding away. We're not very strong. We're not as bullish as we were when we first started, but that's okay. We're just kind of grinding away. We have an 8% PPO between the 10 and 50-day moving averages. You see the Nasdaq's PPO has moved up higher. It's probably not going to get above 12% like the last peak, and definitely not going to get above 15% like that peak. So, we're definitely forming divergent high points here, and you would expect that we'll form a divergent high point again, even at 9.5%. The highest level that we've had in the last 10 years, that would be the highest level in the last 10 years. And if you notice, that is about the highest that we were coming off the 2009 low point, as well as the high we were coming off of 2003, and those were bear market lows. So that's a really, really high level. And you could say, well, dang, we got up to 15, but we were coming off an extreme dip. Nope, we weren't coming off an extreme dip. Not like we were here, which led to that peak. Not like we were here, which led to that peak. We're coming off a little minor dip that led to that peak. So very divergent highs forming there. Of course, the Russell 2000. You notice again we've had a good strong some good strong bullish that's on the daily chart, sorry, here we go. We've had some good bullish candles here. We're flipping up from 0% and now have bullish candles for this week, and we got a green arrow again back above the moving average, and a good bullish candle this week. So positive development and a rising PPO, which has got some room to go to catch up to where the S&P and the NASDAQ composite are. Taking a look at the 3 green arrows, remember that we've only had one index without, and that one index still is not getting 3 green arrows. So diamonds has gotten actually a second red arrow instead. We still have 3 green arrows on everything else. So you notice the MACD histogram is dropping on SPY. It's starting to drop on the Qs. Not quite yet on Russell 2000, so we'll kind of keep that in mind. Again, that would signal converge. It doesn't necessarily signal that we're dropping. It just signals that we're done with the divergence, that we'll start to converge to the downside. Let's take a look at the 2-line versions of this chart. You can see SPY is easily, got that, above the 8-day moving average. All the lines are in the right order. There's a large gap here between the 20 and 50-day moving averages. I told you before that the 200-day moving average here is just breaking. In fact, I have to activate this up to today's high point. There we go. The 200-day moving average sitting right there at the 38% retracement level. Of course, you're going to have a very strong support just underneath the 23% retracement level from a volume standpoint. So that's the benefit that IWM has that Russell 2000 doesn't have. See, the Russell 2000, its 200-day moving average is actually above the 23% level now, and is actually kind of pretty significantly, like it's really getting in there above the 23% level. Again, the SPY for comparison is at the 38% of the same run, of the same move off of that Halloween low point. That's where that's at. The Qs, you'll notice that if I were to activate that, oops, didn't activate that there, and move this up to today's high point. Try that again. No, we got there. So there's today's high point, and again here, let's get rid of this for now. Well, this is the long-term move that you see, the market sentiment rally, but you can see its 200-day moving average is actually below its 38% level, and it's actually sitting at the long-term 23% retracement of the move off the COVID low point. So again, that's why the Qs have a great margin of safety. The SPY's got a great margin of safety. The IWM does not. Again, the 200-day moving average. There's the long-term line there, the 23% of the long-term move, which is lining up to 38%. There's just no volume in the last year below that, and it's getting worse because a lot of this volume down here is coming off the table. So the 1-year volume profile is just getting extremely top-heavy. With this volume at the top. So it's good that we're above the point of control. We're not breaking out, so the point of control still acts as a center of gravity here, just like it was acting like one when we were below it, right? And you can see the MACD and stochastics are moving. If you take a look at some of these indicators to see, okay, do we have breakout moves? The Russell is flirting with 60, just like the CCI is flirting with 100. Again, not kind of the breakout you like to see. Typically, as we saw on June 8th, we were just barely above 60. We weren't close to 200. Back here in that November time frame, you can see we did get closer to, we got up to 187. We were well above 60. So nice, good breakout patterns that you saw here that we didn't see on, that we're not seeing right now. And the same thing over here, you can see that, in early November, we broke out above the Bollinger Bands. And we're not breaking out above the Bollinger Bands now, and just like we weren't in June 8th. So this move is looking very similar to that failed breakout move of June 8th, more so than the actual breakout move of this side of this pullback that we saw in September. So, or last November, coming off of the Halloween low point. So very, very different type of moves here. You can see the Ichimoku trend cloud still very strong for the S&P, and the NASDAQ is getting stronger. The diamonds are also showing an intermediate trend, but kind of slowing down in its strength. And then, of course, IWM is just barely getting above 1 and barely getting above 50. So it's getting to the point where we, again, there's your June levels where we halted at 2 and 65 instead of breaking through. And then going back to November, you can see how we broke through those levels and started a trend. So we're not even to 65 and 2 yet. Even if we're above the cloud. Again, we were above the cloud over there too, and not really making a dent there. So I'm not buying the breakout yet necessarily on IWM still, even as bullish as we've had the last few days, it's still not very bullish. And I would say you still have, gaps. You can see SPY is kind of slowing down there. We still have, in fact, here, go back to SPY, sorry. We still have gaps on SPY. We filled in this morning's. We haven't filled in this gap from Monday, nor did we fill in this gap from last Friday, much less last Monday, which is an even bigger gap. So, but these two especially are common gaps that you fully expect that will fill in. And so that would mean that IWM would also break down and into these areas. And there's its gap from last Friday's way down. So it would be breaking that point of control. So we'll see. This is on the 4-week chart. So we'll see if it's able to do that after getting this good bullish Arun indicator of a new 4-week high point there. Of course, the volume, you saw the volume in the trading range today, very, very light. The range was, again, 1.5 point below half of what the average is. The volume's at 48 million shares. When you look at that in context, again, I told you the ATR is extremely low. It's down below 0.7, 70% of the price, or 0.7% of the price, extremely low. And our today's range was half of that. And then the volume, you can see the average volume is near its own 52-week lows. And then our volume today was at 48 million, which is off the chart to the downside. So it's even more extreme than that. And of course, volatility is also still maintaining extreme lows. A little bit of a rise to the 80% mark, but remember 80% is extreme, extremely low to the downside. So you have very small volumes, very low ranges. And again, barring a catalyst that would spark something like this, whether it's from China or wherever else that the market's not expecting it right now, then we would expect more very small ranges, very small days, biased to the upside, as long as we stay above these 8, 17, 30-day moving averages like we are currently for all the major indexes. So just to summarize the technical outlook, we are strongly bullish. The IWM, it looks like it might be breaking out, and but it's not there. It's definitely not there yet. So don't buy into that IWM story that a lot of people are pushing out there. Not yet, at least. Now, if it breaks out of the sideways channel, then great. But when you put it in context of what we're seeing from SPY, which is a very mature long-term trend, then it makes the likelihood of a breakout to a new intermediate run on the Russell 2000 unlikely. Not 0% odds, because nothing ever is 100 or 0%, but lower odds than normal. So that's kind of my expectation is, okay, well, until we have, a catalyst that would spark more of a broader risk aversion trade, then we'll just kind of grind higher with very small moves and kind of rotate between whether it's the cyclical area, whether it's the XLK, XLY, XLC area, whether it's the safe havens that we saw even today with utilities doing well. You'll see here in a minute. We'll just kind of rotate in, who's buying until there's again a broader risk aversion selling. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. Quick feedback for us. We appreciate it. Subscribe to our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, click on this. That takes you to our Market Outlook live video right here. That's where I review all the old trade ideas I've done in previous Market Outlook videos. We take a look to see whether we should stay in them or get out of them, how we should manage them. We also put on today's trade idea already before the market closed. We do that during that video there. You can see our upcoming trading rooms over here on the right. Click on this heart. It opens up a new tab. Click that like button there. Click on this thumbs up icon, opens up another new tab. Click on that like button there as well. Again, the more you do that, it helps us get our content to all of our followers on Twitter and on Facebook there because of the engagements it has. It's how their algorithms work. That's why we always ask for it. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, now let's take a look at what's driving the price action. And we talked in the past that this little bounce higher that we've had, from the 20th on, you can include the 20th if we include small cap stocks, right? So from the 20th on, we've been on this kind of rally higher in small cap stocks, emerging markets and commodities. The Qs have been kind of following along. This is, a risk off. It's a bounce higher from what wasn't working previously. If you notice, when we were from that July 2nd or first peak, from then on you can see they were down going into that August 20th low point, the most out of all these indicators. You notice they're still down the most, even after their rally and everything else. Kind of all these other asset classes, the dollar and high yield bonds and long-term bonds, kind of stagnating. Gold, they're still lagging behind. So this rally that we've got is still basically just an oversold technical rally. You really see that in emerging markets, for an example. Of course, a very, very big news that China was, which is a big part of EEM. You can see well below on that August 20th. Remember, it's the IWM. That was the IWM rally, but FX EEM did rally off of the open. It really had gapped down on the 20th and rallied throughout the day and closed a lot higher than where it opened, but still way below the 8-day moving average, and for that matter, well below the 50-200-day moving averages. But look at this, in just a week, EEM, which was, again, in a death cross environment, because the 50 days crossed below the 200-day. That's after being in a bullish cross and golden cross environment here for a good chunk of time, really since July of 2020, coming off of this low point. We got a golden cross there, and it kind of flirted with the 50-day moving average, well above the 200. Stayed in the golden cross this entire time. Stayed above the 200-day after breaking the 50 for a while, but traded in the gap, and then the price broke the 200-day moving average here, and then of course the subsequent death cross where the 50 crosses below the 200. But you notice, we have just really sharply moved higher. Like, we broke above the 8 and the 17-day in one fell swoop right there, and one big day on the 24th. That was a big move on the 23rd too. And remember what I tell you, you get your biggest moves when you're below the moving averages, right? So when you look at like this chart here, and you look at EEM's biggest moves, you get your biggest moves when you're below these moving averages, as you see right there. So going back to this chart and looking at it, today we have, again, we broke below the 8 and the 17, broke above, the 8 and 17 day at one point in time. We then broke above, after getting back below the 17, broke above the 17 one day, the 30 the next day, and then, again, kind of trading between the range with a big gap to the upside on the 31st, and then breaking above the 50, but not the 200 today. So now we're in that gap. You can see there's a big resistance above us, but just like that, you see how bullish things can get for emerging markets. The DMI, look at the DMI breaking the positive indicator. Look how high. I mean, now the negative is still unfortunately really high too because of all these gaps. It's really hard for it to really break down pretty hard. But we were really bearish, and then man, have we flipped that script very, very quickly. When you look at like the market forecast indicator, where we had been getting clusters, oversold clusters on both of these low points that we bounced off of, where we were way below the moving average. Well, we bounced off of it again, and now you notice the intermediate line has crossed through neutral zone from bearish territory into bullish with a strong near-term line. So we have the potential for dark green shading and a green line developing. And if you take a look at its weekly candle, after again getting close to a death cross environment, Just like that, we have a green line, a green arrow again, back up above the 10-week exponential moving average with a very bullish candle and a crossover on the Hakenyashi differential, which is from bearish to bullish, with a really good size. I mean, that's a pretty good size candle. And then you would expect that next week's candle, because we're trading near the high here at $53. So next week's candle is going to open up right about 51.5, and then our high is, the close is going to be up there. So we're going to get a pretty good body next week. Again, depending upon how we finish this week, of course. So very nice, good run for emerging markets to really kind of change the narrative that China was just not buyable anymore. You can see the Euro US dollar broke through an important level as well today. So that means the dollar is breaking down below an important level today. Of course, not a significant resistance. We're not breaking above that 38, but we are in retracement mode now, and so we were in retracement mode there too. If you notice, if I were to activate this and move it over here, you can see we were above the 23% line there too, and couldn't quite get going up to the 38. So just getting above that is one thing, but we got to stay above it now. But you got the intermediate line. See over here, you didn't get the intermediate line crossing above 60, and now we do. So we have the intermediate line in bullish territory with a good bullish near-term run. There's an opportunity that we might, be able to hold this breakout better than we did this one, where we were just barely above the 23% line. Of course, that's going to have a bullish impact on gold prices. Even though we're kind of neutral, you can see the gold's intermediate line is above 80, even if it's not quite very strongly above the moving average there. And then, of course, commodity prices has been another big dollar-related trade. Again, you can see how bullish they are, and you can see the intermediate line did get above 60, but it's already kind of the near-term line is already petering out, and the intermediate line looks like it's unable to get back above the 80th percentile. You can see the histogram's already peaking. Resistance appears to be holding. Remember, this is trading with small cap stocks too. So if this is unable to break out, then again, it's going to be hard for small caps to break that mold. From what it's been trading with over the last so many months. It's been trading pretty much hand in hand with emerging markets and with commodity prices here. Let's take a look at the sector moves. So let's come down here to the sector comparison chart. Again, you can see where the strength is and where the weakness is in these cyclical areas. Financials, industrials, materials, energy are the cyclical losers right now. You have XLK, XLC, XLY, your QQQ type names outperforming today. If you take a look at just how things performed today alone, so let's come over here, then you can see again that's where the weakness was in those areas. And remember, those are the areas where the strength has been, and those are the areas you would expect the weakness to come from. In fact, again, if you look at the chart here, the rotation graph, you see that energy, financials, industrials, materials are all rotating in the wrong direction on the long-term chart. And then you can see on the daily chart, they're really moving in the wrong direction. Materials, financials, but so are staples, healthcare, and utilities also moving down. There's industrials, there's energy, and you can see XLK, XLY, XLC making a run to the upside on the daily chart to kind of match a little bit of what they're seeing here. There's XLY, XLC, XLK, and then healthcare, kind of mixed picture there. So, but these cyclical areas really weakening, and they had been the strength. They had been by far the strength, right? Coming off of that September 24th low point where they kind of bottomed out before the broader market bottomed out. That would have been last year. If you notice, they had been by far the strength. You can see materials and industrials has now been caught up to by the rest of the market. XLK has passed it. Real estate not quite yet. XLC has passed them. So they've caught up. Some of these others haven't quite yet, but you can see financials and energy are still, they had very strong moves up to about right in this area, even up to mid-May, and they've been going sideways this entire time. Really, they kind of peaked here initially, but financials peaked here in June, early June, for getting another little peak here at this side. But you can see materials and industrials both peaked in this mid-May timeframe as well. From that point, these areas have been sideways, and these other kind of QQQ names have been catching up, while the safe haven areas have been lagging behind. So we haven't flipped the script yet completely to where these sectors have completely rotated out in the wrong direction, and safe havens have rotated in to the green quadrant there. Of course, those are all signs of a maturing bullish market that we've been in, and we could be in for who knows how long. It's just a matter of sector rotation between those two cyclical areas of the market, whether it's the areas that are more correlated right now with the Russell 2000, materials, energy, industrials, financials, or the sectors are more correlated with the NASDAQ 100, the XLK, XLC, XLY. So it's just kind of a rotation into either one of those until the safety areas, which have had their time too, actually during this bullish run, but not strong enough to where, like I said, they've been in that green quadrant and really entrenched, while all the other areas have been in the red. So let's take a look at Nike as our trade idea for today. This has been a bullish trending stock. It got a cluster and then fell out. You can see the intermediate line now after this cluster is out of the reversal zone. Bearish short-term sentiment sentiment's been in the bearish territory for a while. We're not too far below the moving average, 2.5%. So we're not necessarily strongly bearish here, but we're definitely not strongly bullish anymore either. You can see we've got some bearish candles rolling over PPO. We don't have the red arrow yet, but you can see how close we are to getting one on that particular chart. We are below the 30-day moving average, and at least far enough below, but still above the 50, though. Again, that gap is really shrunk, and there's not a lot of volume in this area, so very easy to trade between that gap between the 50 and the 200-day moving averages, with your MACD falling, the 8 and the 17 below the 30-day moving average there. If you take a look at like the RSI and the CCI, we're not in bullish territory anymore either. We're down towards the lower end of neutral territory. If you take a look at the DMI, which had been strongly bullish, now not so much, and you can see the positive indicators falling below 20. The negative is above 25 at least. Not quite at breakout levels yet, though, above 30. When you look at the Bollinger Bands here for Nike, you'll see that, again, very light volume. We are in the lowest quartile of the bandwidth with a rising bandwidth. So it kind of sets us up for that kind of move. You can see we got the red bars, and today is the first day where we got the green dot, where the Bollinger Bands are breaking outside of the Keltner channels, and we're really pushing against that lower Keltner channel there. So at the very least, while we might not be strongly bearish, we don't have to be strongly bearish to make a bearish trade. We can sell a call spread, so sell the 170 here, buy the 175, sell that call spread, and you can see what that does to the portfolio. You can see it puts a break even there at 171. So if I set that slice to the chart, it puts our break even above these recent highs. So that puts us up, when you look at it this way on this particular chart. We'd have to really kind of break back. Instead of breaking, we've got a new 4-week low point here. We'd have to break back through all these highs, through last week's high, through the point of control, and really kind of change the direction, the trajectory of the stock. So I like where that break even is. And then again, for the risks that we're taking, we're getting a pretty decent reward to the downside as long as we stay below this 170 strike price, which as of right now is at the point of control there. Alright, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions you have or any comments about anything I discussed in the video. Reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as to our website at marketscholars.com. Click on that like button, that thumbs up icon, as well as like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.